Hello again, this is again Francesca Dalmas from IAL Friuli Venezia Giulia within the FASST project. Let's go to unit number 3, how to develop a financial plan. So, in this unit we will see the concept of investments and other purchases, the concept of long and short term and planning, and the concept of third-party capital and equity capital. So, the first issue when it comes to financial planning is how much money do I need? So in this sense, we definitely need to evaluate which investments are needed to start up the business. So what is an investment? An investment is an asset or an item which is acquired with the goal of generating income. In an economic sense, an investment is the purchase of goods that are not consumed today, but that can be used also in the future to create wealth and to generate benefits from the firm. So the question is, what do you need to start your new business? Let's see some example. So to start a social farm, you might need a tractor, you might need a shovel, or you might need a piece of land. So all of these items, they are all investments. In fact, you buy them now, you will be using them for a very long time. Maybe some items last more than others, but anyway, you will not use them only for 1 year. You will use them for many years to come. So how long will you be able to use them? The tractor can be used for several years, the shovel for some years, then you will probably need a new one, but your piece of land can be used forever and ever. But starting up your business, you might also need other things like seeds or water or fodder or bran. In this case, these are not proper investments. You buy them now, but you will be use them in a very short time, and afterward you will probably need to buy some more. So in this case, what you need to do, you first need to make a comprehensive list of all your investments and define their prices. Eventual taxes like VAT need to be defined as well. So what's the aim of that? You need to know how much money you need. Beside investments, it is also important to define and consider a comprehensive list of other purchases, even if they are not considered as an investment from an accounting point of view. And also in this case, eventual taxes or extra charges like VAT need to be known and considered in advance. So from an accounting point of view, bookkeeping in this sense, you will need to divide the investments from the other purchases. So investments will be reported year after year, and they will include it pro quota in every fiscal year of their usage, while the other purchases will be reported only in the fiscal year of their eventual usage. From a financial point of view, you will need enough money to buy it all, otherwise you cannot start your business. So you will need to buy both assets that can be considered as an investment from an accountancy point of view, as well as other goods or purchases. But it is relevant to know exactly how much money you need to do this all. So in this case, we need to know how much cash we need to have to buy everything we need to start successfully our business. So in this case, the question is where you can find the money, where we can find the money. So we have two options. One option is third-party capital, which means that we ask someone to lend us the money. We borrow money from someone else. In this sense, third-party capital can be either short-term or medium or long-term. Or what we can rely on is our own money. Our own money is called equity capital in accounting. Equity capital is always long-term. So when we need how much money we need to look for, then again we come here. I don't know why, but anyway, okay. So we need to define about the third-party capital, that we need to define it as the one that belongs to someone else, and this someone else is not related with our organization. So third-party capital is borrowed from someone else. This someone else might be a bank or a financial institution, other institutions, even not financial ones, one partner or someone who is close to the partners and wants to, let's say, be enough generous to lend some money. And in this case, what we need to know is that third-party capital needs to be paid back according to a specific plan or a specific contract. What we need to know is that third-party capital usually, but not always, generates interest. So this means that money has a cost too, and we need to be ready to pay this cost back. So it is relevant to understand how much this will cost us and to check if it is affordable and in line with the market. So the suggestion here is to try to investigate about the opportunities to borrow money at a reasonable cost. This is particularly interesting and doable for social businesses because there are institutions, even public ones, willing to lend some money at a very reasonable cost to help this business, let's say, grow. Third-party capital can be short-term or medium-long-term, so it depends on what the company needs, and we'll see this very soon. On the other hand, we have seen that equity capital is another option. Equity capital is the money that belongs to the partners of the venture. So the partner wants to invest. They invest in the startup to support its initial financial development. Equity capital is not meant to be paid back. It will remain in the organization during the entire life of the organization. The partners will eventually recover it if they sell the firm or some of its shares or when they close the firm. For this reason, equity capital is always defined as a long-term tool. Equity capital does not generate interest, but this does not mean that it has no cost, at least from a theoretical point of view. In fact, entrepreneurs that have some cash and decide to invest the money in that specific venture, they might have chosen to invest the money elsewhere. Thus, equity capital should generate profits for its owners in terms of dividends. In most countries, equity capital, or at least a certain amount of equity capital, is mandatory to start a business, and equity capital follows specific rules. So it ends up that most organizations, they use both equity as well as third-party capital. The issue is more related to the use of short-term third-party capital rather than long-term capital, either third-party or equity party. So there are some financial golden rules to be taken into consideration. Let's start from our initial example one more time. So if you remember, the investments were the tractor, the shovel, and the piece of land. So what kind of financial tool can we use here with better use? So these are all investments. You remember, you buy them now, you will be using them for several years, or even in the case of piece of land, theoretically forever. So the utility of these investments are definitely long-term. It makes then sense to finance their purchases with long-term means, either borrowed, so third-party capital, or equity capital. But if you remember, the startup also needed the seeds, the water, the fodder or brand. So in this case, these were not proper investments. You buy them now, but you use them now, or anyway in a short term. Afterward, you will probably need to buy some more seeds, some more water, some more brand. So in this case, it makes sense to finance their purchase with short-term means. Hopefully, the ongoing activity will generate enough cash to finance future purchases. But in any case, it makes sense to use short-term tools in this case. Here, you can find a useful book, Introduction to Agricultural Accounting, that investigates these topics and some more. So now it's time to go to unit number 4.